Hello, everybody, and welcome to a new episode of Reinvent Money. Today, my guest is Hugh Hendry, Eclectica, a former hedge fund investor who runs the Asset Capitalist podcast. He shorted Lehman Brothers, Fannie Mae, and Freddie Mac way before they went belly up. And this time around, he also expects markets to be going as bad, if not worse, as in 28. He's now living a life in St. Barth most of the time, but he's also traveling across the world. I think right now he's in London. Hugh, welcome.
Thank you. Yeah, I mean, I look as if I've been detained in a prison cell. Part of the unglamorous element of world travel is when you have to stay at the airport hotel. So that's where I am. But I split my time between St. Bart's, Paris, London, and Los Angeles.
Yeah.
But nice to connect.
Yeah, I was expecting this beautiful scenery of the Caribbean, but yeah, it's a bit different.
Next time.
Yeah, I was triggered by this thing you said in an interview the other day that you expect markets to be as bad or even worse than in 28. In 28, you made a fortune betting on the right direction. Could you elaborate? What do you expect in the markets the coming time?
Yeah. So I don't think there's no great financial honor in the confession that I was short Lehman Brothers, the Fannie and the Freddie Macs, the government-sponsored mortgage financing entities. I was short them way too early in 2003, which was my first calendar year as a hedge fund, macro hedge fund. The point being, the curiosity was switched on, but what it reveals, and I think it's an important reveal, is it's the gap in the curtain, which is the title of a short story by the author of the 39 Steps, John Buchan. And it's a story where a mad scientist, if you will, can train the mind to read the front page of a newspaper 1 year in the future. And one of the protagonists is an investment banker, and he reads of a great merger between two very large African commodity groups, and the thrust, the pace, and the question of the book is, what happens to your life when you are forewarned of events, and without wishing to ruin the suspense, life is capricious. So even when you fully disclose what's going to happen, you're not actually guaranteed to make a return. And there were certainly many prominent investors in the year 2008 who were short those names, and so their timing was impeccable, but they never actually earned a profit, because the route from A to B was profoundly volatile. And the route there, which involved, in the month of September, a blanket ban on shorting financials. We never conceived that would happen. Right. Where effectively we were taxing the truth tellers, where the truth had become so overwhelmingly negative and almost outside the realm and the power of the sovereign governments to respond, that their knee-jerk reaction was to ban the truth. And that caused a short squeeze, and people didn't make it. Now, I made it I made it. And I made it to the end of the year with a 30% plus profit, because by then I had structured my trade within the world of fixed income, which wasn't subject to these bans by governments.
Yeah.
So
it's always very difficult, of course, to get the timing right. But how would you? Will we have the same rocky road ahead of us the coming years, and what do you expect the governments to do again, perhaps to censor truth tellers in the markets?
Yeah. So the opening question was, why do I think, and let me just say, there is no certainty in my world. And I have a lot of disdain for expert opinion, and indeed central bank and government opinion, because it is communicated almost as fact. There are no facts. There are speculative propositions in my head, and I go seeking a probability assessment, and then I look at how the market prices it to determine whether we agree or not. Okay, but as a rough rule, if it's going to be of the same magnitude or worse, then you'd have to imagine that the pushback from governments would be extreme. And that could mean, it could, but what would be extreme in this world might be capital controls. It may be that, again, if the situation gets out of the control of individual sovereign nations to respond, they might actually bring in supranational entities such as the World Bank and the IMF. And the IMF are very much in favor of capital controls. And we've seen that in Europe in the last 15 years with Iceland. And we saw it with, is it Cyprus? And we saw
Greece as well.
And Greece as well. So one has to give possibly more attention in the construction of a trade. The easy part is almost the A to B, right? And the denouement, the event. The hard part is constructing the trade and having the talent to withstand the pressures to last the journey. So I still haven't answered your question. I fear that it could be as bad, if not worse, as 2008, because central banks are pursuing a Volcker strategy. What is a Volcker? That is named after Paul Volcker, the chairman of the Federal Reserve, appointed, I want to say, around 1979, possibly earlier. And he had the audacity to be honest and say, we have an inflation problem. And the solution that he offered was to raise interest rates, and to raise interest rates going into a very, very deep, in fact, the deepest post-Second World War global recession. And that was shocking. Now, I wish to say that the consequences from that action were the consequences, or that policy reaction was okay, because the level of outstanding debt in the economy was modest, that we had spent 40 years deleveraging from the crash of 1929, that society was appalled with what too much debt can do to family households.
Right.
And so he was raising interest rates when debt to GDP, to the size of the global economy, was roughly between 1 and 1.5x. Today, my concern is they are messing around and raising interest rates in a recession. The US has recorded 2 consecutive negative quarterly GDP prints. And they're doing so against the background where debt to GDP is somewhere between 4 and 5 times. And we don't know what happens when you raise interest rates against that background. And there's one argument which I am fearful of, which is the whole thing falls down. Like, I think we can deal with bubbles in terms of inflated asset prices, and inflated asset prices manageable as long as households and corporates can manage their cash flow. It becomes an issue of profound concern when you re-engineer and you put pressure on their cash flow via interest rates. And so, having seen the 30-year mortgage rate more than double in America from 3 to like 6.5%, that would be a profound source of strain. And that would be a concern of mine.
Yeah, and it's also so morbid for a central bank to actually pursue demand destruction after first creating a huge bubble of wealth illusion. It is this whole idea of basically trying to tame the cycle, but actually making it worse by making the peaks higher and the valleys even much lower. That whole concept is still mind blowing that we allow the system to work that way.
I think future generations will look back and say it was mind-blowing that we would consent as social democracies to have a committee-based decision on interest rates by, I think there are 9 Federal Reserve governors who meet, and they meet every 6 weeks or so, and that somehow in that room resides greater intelligence and wisdom than the thousands of financial participants who each day have to make reputational decisions on where they think interest rates will be, because there's a lot of commercial hedging, there's a lot of speculation, but those decisions manifest themselves in the yield curve, in the price of the 10, 30-year tenors for US treasuries and European sovereigns. And if you're wrong in your calculations, if you're consistently wrong, you go out of business. And so there's a penalty for being wrong. And it would seem that central banking is not disciplined by the same penalties for making errors, which is to say, they continue to make the same errors. Remember, the ECB raised interest rates 75 basis points this week. The same ECB that raised interest rates in June of 2008. Yeah. So we were amidst the greatest economic downturn. I said to you, 1979 was the greatest. It was surpassed by the NASDAQ crash at the turn of this century. And then it was surpassed by the great financial crisis. Okay.
Yeah, but the ECB, of course, has to play along, because otherwise the exchange rate with the dollar would weaken even more, and we would import even more inflation here in Europe, right?
Why do you say that? Because forgive me, I'm pressing back, because I believe this is a common misperception. So tell me what motivates you to say that.
Now, for example, a lot of the inflation in Europe is energy driven, and energy is being paid for in dollars. If we continue to weaken our exchange rate with the dollar, then we would pay even more for energy prices that are already on an elevated level worldwide. So aren't we then, do we have any other choice than trying to catch up with the dollar?
What determines the prevailing eurodollar exchange rate in your mind? Well, which factors?
Yeah, of course, the most important part would be our trade with the US.
Well, yeah, I mean, that would be a function. Remember, commercial. So, for instance, the Chinese currency has only recently begun to slide versus the dollar, but up until 6 months ago, it had been stronger than the dollar, which had been stronger than any other. Which is to say, the Chinese yuan had been stronger than all other currencies. That was a function of trade flows. China's trade balance with the rest of the world blew out to 8% of GDP, and macro hedge funds or speculative trading flows, which would be another force in the FX market, did not wish to be short against that commercial flow. Within Europe, it's less obvious that the commercial trading balance, exports, imports, would be a huge determinant of the euro-dollar exchange rate. So what I want to say is, I fear that you were suggesting that the euro has been weaker and that the default setting of the ECB is to raise rates, that is outside its control because the Federal Reserve has been aggressive in hiking rates. I think that is a fallacy. I do not believe that is a determinant in the movement or the prediction of FX rates.
But another reason for the ECB could be to raise rates in order to also destroy demand, basically, because they cannot do much on the supply side, because we have, of course, supply side issues and shortage of certain commodities, especially gas in Europe, and by destroying demand or by raising rates and slowing down the economy, at least that's of course what traditional theory would tell us, it would lead to lower prices just by diminishing or destroying, I don't like the word, but that's what they're using, the demand. It could help alleviate price or alleviate or lower prices. Would you agree with that, or is that also a wrong path?
So I think that demonstrates everything that is wrong with modern or indeed ancient central banking. Let's just say central banking. The European economy is accelerating into what will probably be a recession greater than 2008, owing, as you say, to the spark being the Russian-Ukrainian confrontation, the dry powder being how European policymakers destroyed the sovereignty of the European region by failing to reinvest and therefore secure viable long-term energy resources. I don't think you're a sovereign if you cannot. Energy determines everything, and if you lose energy, you lose sovereignty. So, and if we need a common anchor point or reference point when we talk about energy. So let's use barrels of oil. Barrels of oil, the global price is circa $90 today. European households have no choice but to pay $600 this winter for heating bills, whereas that would be $19 in the US. If we put that into the kind of BTUs and natural gas in America trades for 10, and it trades for something in excess of 80, 8x, 10x in Europe. Yeah. So that pressure itself is pushing Europe into a recession. The fact that energy will be rationed, there will be blackouts, there will be a profound recession. So why on earth would a central bank seek to make that situation even less palatable? Demand is being destroyed by the naivety of not having an independent energy source. Energy will be rationed, GDP will contract, and now you have what would seem a mendacious, blind central bank raising interest rates.
Yeah,
that makes no sense.
No, and you could also argue that in order to increase your energy production, you actually need lower interest rates in order to entice investors and companies to invest in more energy production and exploration. So they're going to make things worse then, right? That's basically what you're saying. We already are in dire straits in Europe, and the only thing ECB is going to do is make things worse.
They're doing self-harm. And it's not just the central bank. I think I read today that the European heads of government came to an agreement to have a windfall tax on energy explorers, producers, to pay for the government intervention to cap energy prices for the household and corporate sector. Now, that's a little bit like if we reverse the clock to the summer of 2020, and we're enveloped by the misery of COVID, and the government, rightly, because it's insisted that people stay at home in confinement, it is offering a financial recompense for the loss of income. That would be, I think, that would be anomalous. I think it would be analogous to taxing pharmaceutical companies. You need pharmaceutical companies to find the solution, to push back the virus. Exactly. And you come in and you super tax the pharmaceutical companies. Neither of those things would make sense. Why did it? Rightly, they rejected that in 2020, but now they're pursuing it.
Yeah, and of course in Europe, the energy market is also very much tied and coupled to the gas price. If the gas price goes up a lot, and then as an energy company, for example, you produce by using wind energy or solar energy, then you're making a ridiculous amount of money because your sale price is coupled with the gas price, even though you don't have these input costs. So in a way, I understand why you would want to change that system, or at least in the meantime correct the system by taxing these companies more. I guess it also sells to the public, right? The public is in stress. They have high bills, and they see certain industries making a lot of money. So yeah, it's easy to sell.
Well, I would bring you back to the world of Adam Smith, and I'd also bring in Gresham's law. Gresham's law, I think it's Gresham's law. Forgive me if it's not. Good money drives out bad money. Bad policy.
Bad money drives out good money.
Yeah, forgive me. And bad policy drives out good policy. And bad policy is typically the one that you can sell to the population. And sometimes there is a tyranny that the majority can impose upon the class of society that's actually awake, that's actually thinking. That's where we are today. So bad policy, this policy where we've discussed these windfall taxes, are justified because the majority approve of it, but the majority are not conscious in their thinking. And to cite Adam Smith, the argument would be the super profits, if you will, of those green energy providers from solar to wind would have a huge profit incentive to invest in more and more capacity, and indeed to fund the necessary expenditure on battery technology to store the damn stuff, and to work on green hydrogen solutions, which would be closer to Europe. Clearly, you need perpetual sunshine, right? And the suggestion that you take it from Australia is one suggestion, but it would make a lot more sense to take it from Northern Africa. Of course, there's a profound issue with the instability of those geographies. But Adam Smith would say, provide the profit, and the private sector will, we're talking about a shortage. If you wish to alleviate shortage and have the private sector respond, create a pricing incentive and then sit back and watch the solution. So maybe you don't want to sit back and you have to be interventionist. At least impose a windfall levy, but only on the basis that it's applied to those companies that choose not to invest.
Yeah, well, that's exactly the argument they're using. The industry, the solar and wind industry, are exactly using that argument that they need the profits in order to finally invest more and increase capacity. And like you said, bad policies, they drive out good companies. So you get like a gulch. Yeah. Hey, so you travel the world. You can see things from a sort of a back perspective, like saying, okay, this is happening in that country, this is happening in that part of the world. Do you see a lot of future in the euro as a social construct, as a monetary construct? Do you expect it to last for much longer? Or?
Those that know me or are aware of me will say, "Oh God, it's Hendry again," and therefore he has negative. He's fearful of the sustainability of the euro, and he is fearful of the high esteem in which the Chinese economy are held. And so, if you will, there's a legitimate pushback that I have been a perma bear on both the euro and China. Mea culpa. All I can say to you is that there have been periods in time where I have found trades where such was the confidence of the majority in the status quo, the euro, the status quo, the supremacy of China, that I could put trades together which were betting on the destruction of the euro, on a profound slowdown in China, and they were cheap. Now, what does cheap mean? It means that I could get a lot of convexity, which is another way of saying I could make, if I'm right, I could make a fistful of dollars. But the consequences of being wrong, it's not nice to be wrong, but I would be fearful of being wrong because the price of the admission to that speculation was cheap, was modest, that I didn't have to put too much down. And so that's found me with those bets. So you asked me about the euro and sustainability of the euro. There is a global hedge fund manager that I'm very close with, and we discuss things on and off. And he's going long the euro, and he's versus the dollar. He believes that internal interest rate dynamics now favor a carry trade in favor of the euro. And we haven't had a deep conversation about this. We were exchanging things on WhatsApp last night, and I said to him, "That is the dumbest ass trade I have ever heard." And he didn't take kindly to it. Now, I have no monopoly on what happens, and I'm usually wrong. That's why I look for trades where I don't fear being wrong, because I'm typically wrong. Yeah. Why don't I like it? There's momentum. The dollar is clearly trending higher, and the euro is clearly trending lower. I think people are wrong to attribute that to interest rates. We've discussed that. I think a part of that would be the sentiment and the reality of the energy crisis, which is generating, again, without the intervention of central banks, is destroying demand. And then we have central banks raising interest rates at quite a sharp pace in order to destroy demand. So that certainly would contribute. It doesn't feel like a safe thing to own euros when there seems to be a lot of self-harm.
Yeah.
But finally, and I think with greater relevance, and not many people are reflecting upon this, is that the decision by Mario Draghi, I think was it 2013 or 2012? 2012, when he said we will do everything, right? BTPs are a Euro central sovereign. They are almost interchangeable with bunds, and we saw the yield differential between Italian sovereign 10 years versus their German equivalents. There would typically be a huge risk premium to reflect on the idiosyncratic risks of the Italian political scene. An argument that I saw with the financing of the US housing market in 2003, 2004, 2005, 2006, and 2007, which was the creation of mortgage-backed securities. It was being able to pool mortgages and create a portfolio which was geographically diversified. And because there had been zero observations of a national house price crash, then that was deemed to be almost impossible. And therefore, the combination of geographically diverse mortgages, paying you an income, came to be conceived of as less risky than the US government bonds, which is to say that in the eurodollar, the private banking arrangement, which is responsible for creating money. So the eurodollar system creates money, not central banks, not the Federal Reserve, not the ECB, not the Bank of Japan, not the Bank of England. It is private money center banks facing each other off every day and willing to accept each other as counterparties. They determine money printing.
Yeah.
And for them to take on commercial risk with each other, it's reputation, and they have to post collateral between themselves. And so the great determinant of money printing today and the looseness of economic policy is really the availability of the collateral that the money center banks will use to regulate their trading between themselves. At the turn of this century, they started to use mortgage-backed securities, to accept mortgage-backed securities as collateral. But when the risk of a nationwide house price decline became more and more apparent, then they refused, and they started to demand that their counterparties take back the mortgage-backed securities and actually replace them with US government bills. Okay, and so that was a dollar for dollar swap, and that created a huge bull market in government bonds, which is to say yields fell to almost zero. Okay, and we had a crash. And I want to say to you that there's a possibility that the eurodollar system has been using Italian government bonds as collateral to regulate the printing of money. Why? Because Germany doesn't produce enough collateral, it doesn't produce enough bunds, because fiscally they are obligated to run primary fiscal surpluses, so they don't create the need to issue bonds. And so the world of global banking needs something bigger and more what I want to say, flexible, like you can contract it, you can expand it, than that offered by bunds. So what if instead they started using 10-year Italian bonds, which I think are either the third or the fourth most liquid bond market in the world? Think of that. Italy is the third or the fourth most liquid bond market in the world. All right. And then we get this situation, this disaster in terms of this energy shortage, war within the boundaries of Europe, or on the periphery of Europe, a central bank seeking to destroy demand on top of the demand being destroyed by the energy shortage. What if the counterparties are saying, you know what, I love you. We've had this, we had lunch yesterday. You spent a lot of money. The wine was fantastic. The food was delicious. But I need you now to post US government bonds or German bonds and take back the Italian. Now, if you're replacing the Italian bonds with US Treasury bills, there's an FX component there, and you are selling euros and you're buying dollars. So that's the unspoken, and it's the unknown variable, which, if I'm anywhere close to being correct, takes you back into the world of 2008.
Wow, that's a very interesting train of thought. There's so much to think about. But do you have any idea what percentage of the total supply of Italian bonds is indeed being used as collateral by the eurodollar system, for example?
We have no idea. All we can do as macro investors is look at the ripples at the surface level where we see prices. Okay. And so the determinants would be the euro-dollar exchange rate. The determinants would be the spread between the yields of Italian and German government bonds, and the internal pricing structure of where you price different tenors within Europe vis-a-vis the US. That will not give you, there's no precision. If you go seeking precise answers within the world of macro, you will never succeed.
No,
this is a game of
probabilities and prices. Yeah.
Supposition, and being willing to have intellectual speculation about what might happen, and not a determination of what will happen.
No. And the difference between yields of the German and Italian bonds are being suppressed by the ECB, or you don't think they have that much of an effect or an impact, especially now with the latest TPI program, commonly known as To Protect Italy, or of course the transmission protection instrument. Is that something that's suppressing the difference between German and Italian bonds, or not so much?
It will be a factor. How great it is, I don't know. The market beat the ECB came out and they spoke vaguely about this new program, and that they would potentially be buying exclusively within their quantitative easing programs, that they could switch the emphasis and just buy the most commercially exposed sovereigns, so buy less Northern Europe and buy Southern Europe. They haven't given detail to that, and so we don't know. And in the world of risk, where you get punished by being wrong, by losing your job or by losing your bank's reputation, people are more conservative and would rather kind of, bring down risk levels. So we don't know. And then you come to the very uncontrollable aspects, which are, Italy has lost the kind of reassuring presence of Mario Draghi.
Yeah.
And we have the precedent that the UK chose to leave the European system. And there is a probability, and probably the probability could be assigned as no greater than 10%, and is probably below 5%, that the Italian population could swing to the right and reject the euro. That wouldn't be rational, but that bad policy drives out good policy. The fact that it wouldn't be rational, it's not rational to have a windfall tax on energy and energy exploration companies, but they still do it. So they're unknowns, but we're trying to discuss them and bring them out, bring light upon them, and so that people with greater expertise than me, I'm a provocateur, and I want people to say, "Oh, shut up and give me the facts." So I'm listening.
Yeah, you're a macro artist, right? I love how you describe yourself as a macro artist, because you said in the interview that I read earlier that there's only 5 people that understand money worldwide. Enlighten us. Who are those people? I want to follow them.
Well, my deal with the 5 is it's a bit like Satoshi or whatever he's called with the Bitcoin. I'm sworn to secrecy. But it's a little bit like when the former monarch in the UK, Queen Elizabeth II, in the aftermath of the great financial crisis back in 2008, and she had this question: why did no one see it? Okay, and it's because there's kind of only like 5 or so crazy people that are actually attuned to understanding the complexity of money.
Yeah.
And they do not run central banks. They do not run hedge funds. If they did, the ECB would not have been raising rates in 2008. If they did, then hedge funds would have, especially macro, would have consistently made money in 2008. They didn't. So again, the footprint of the ignorance reveals itself with regard to price and subsequent performance.
Yeah. Well, maybe as a final question, I talk to Jeff Snyder every now and then. Maybe he's one of the 5, but at least he has a thorough grasp of the eurodollar market. Something that you already mentioned yourself, how important that's where most of the money, and or at least the credit creation, is taking place. How much will the eurodollar market suffer if the dollar is it keeps on appreciating? Because I would expect that emerging market companies and countries are going to go down the drain if the dollar keeps on appreciating, and that could potentially bring down the euro-dollar market. And as a subsequent question, do you expect developing markets, especially BRICS nations, to start using their own currencies more instead of the offshore dollar? So it's a long question, 2 questions. Let's see.
Great question. So Jeff Snyder. Jeff's changed a lot in the last 2 years, from being a kind of bookish librarian, and today he resembles Jesus. Yeah, what is it with these?
Yeah, I'm trying to, but
the beard and the hair and I think of intellectually. I think of Jeff, the collateral strains of the global euro dollar system, I believe, are foremost in determining the rise of the dollar, and not the inverse. That the dollar is rising because the dominant collateral. So again, if you wish to borrow, you're borrowing in dollars, and you're going to go to a bank outside of the US. That bank is going to require the posting of dollar-based collateral, which is to say dollar treasury bills. As as the global economy slides into this recession, and as central banks, to quote you, as central banks seek to destroy more demand on top of the energy crisis, the commercial risks of lending within the eurodollar system have just been increased, and therefore the desire to offset risk manifests itself in an insistence that you post more dollar collateral, i.e. you've got to go and buy dollar treasury bills. And so you are buying dollars and you're selling something else. That's the mechanism which takes the dollar higher. So the dollar goes up, not because the US economy is outperforming, but because there is a fear within the global banking community that we're heading into a very, very deep recession. With regard to BRIC countries wishing to replace the dollar, dream on, okay? Because the world is not set up that way, okay? There is no demand within the eurodollar system to accept Indian sovereign 10-year as collateral for a dollar loan. And there's no desire likewise for 10-year Chinese sovereign as collateral for a dollar. Everything's a dollar loan because, like as you noted, the oil price, everything's quoted in dollars. It's the go-to place.
And what do you make of these news flashes then, that there are all these bilateral deals between Russia and China, or India and Russia, that trade is taking place in local currency?
Yeah, I zone out. You know, so I did a thing in the UK today, one of the biggest kind of news podcasts, and it was arranged at short notice. And it was only when we were live that I realized that I was invited on to talk about the inflation print from today in the UK. I didn't know. I don't care. It was partly, it was higher than expected. And the US print was actually a little bit less. It's noise.
Right.
If that is grabbing all of your attention, if you are actually, let me say it again, or for the first time in terms of our conversation, the French for a bat is a chauve-souris. Now, bats are blind. The chauve-souris is a bald mouse or a bald rat. I think of central banks as being bald and blind rats, which accentuate the volatility of our global economy.
Right.
And I don't spend any time listening to their propaganda.
Well, I find this great words to end the conversation with you, because I already took quite some of your time. I want to thank you for your provocative and eloquent thinking, and I'm sure our viewers will love this. Where can people find you?
People can find me at blog. Well, heavens! I mean, you know, I wear the hat. If you see the hat, reach out. I'm always happy to discuss things. You can find me on Hendry_Hugh, I think, at Hendry_Hugh on Twitter. We put out a podcast every week, supplementing your great work. We have the Asset Capitalist.
Yeah, I love it.
Which is on the Apple platform, and we publish that on YouTube. And we have a Substack, you know, coming under my name, and you can find us also on Instagram. We've had fun this week. I put out a rather melancholy piece, which was going back and visiting from 40 years ago, that my childhood beginnings, and it's all being destroyed. It was a gruesome, poor experiment in social engineering, and it was so bad they had to destroy it all. But in my head, it still exists, and so the juxtaposition of seeing something which no longer exists, you know, again, it's very much Matrix. When you start taking the red pill, and you start in, like, where is reality, and what is reality, and what is imagined? So that's the world of asset capitalism, and we're looking for new tribe members. What about your book? The book is the biggest tease ever. I will be self-publishing the book at some point.
Okay.
And the book is written as a kind of a rock and roll adventure in finance.
Yeah, I look forward to buying it once it's available. And thanks so much for sharing your thoughts, you. And hopefully one day I get to meet you in St. Barth.
Well, indeed. And hey, listen, go to acidcap.com and buy the hat. Or get the one that says, I recommend you panic, because panicking today is the most subversive thing you can do as the ordinary guy, because everyone's screwing you. So get the hat, acid cap, or panic to say, screw it. I'm panicking. This situation is bad. I need solutions. I don't need the status quo.
Yeah. Okay. Go to the streets. Thanks, you.
Thank you.